This program is brought to you by Fannie Mae, the lending partner with the products, people, and technology to serve your customers and help you grow your business in the best ways possible. It's why they say, at Fannie Mae, greatness lives here. Disclaimer, Fannie Mae TPO is a division of Fannie Mae Loan Services, LLC, Equal Housing Lender, NMLS ID number 35953. Loans not available in New York. Licensed by the Department of Business Oversight under the California Residential Mortgage Lending Act. Conditions and restrictions may apply.
This is The Interest, your balance of today's news. I'm Christine Stewart, and these are your headlines for today, May 2nd. With shrinking refis and a sluggish sales market, lenders across the nation are looking for alternative products to push. In a new cover story from NMP Magazine, there's industry consensus that non-qualified mortgages are supposed to be that hot new loan of the year. But some analysts don't share that optimism. They think non-QM loans will be nothing more than a niche product. We're joined now by Doug Page of NMP Magazine. And Doug, why are so many lenders jumping into non-QM?
The mortgage market has dropped quite a bit this year. Refis in particular have taken a bit of a nosedive compared to last year. And so the result is that lenders are looking for new ways to make money and new loans to write. And as a result, the expectation is that non-QM lending will increase by 50% this year. And this is a call coming from people who are inside the industry.
You wrote that analysts don't necessarily share that optimism. So what do they think will happen with non-QM loans?
Analysts have got a very, very different view of life. What we're seeing in some cases is we've got a quote here from Kevin Heel is an analyst over at Argus Research, and he says that non-QM lending will be what it has been, will be what it is. 5% of the marketplace, and that's about it. It's never going to reach 25% of the marketplace. And we've got some disagreements with analysts too as well, where we've got S&P Global saying that indeed non-QM lending will increase sizably this year, yet we have one of their own analysts who follows the real estate market saying, no, it's going to remain what it is.
How are lenders responding to this criticism, and why are they so optimistic?
Lenders, on the other hand, are saying that the analysts are completely wrong, that what they're seeing is that their numbers are going up, non-QM lending is going up month over month, and they expect it to continue for this year. They also point out that analysts have never been a loan officer, that they've never felt the pressures of a loan officer, and that as a result, because they have never felt that kind of pain, that kind of pressure, that indeed they just don't know what they're talking about. So the result is people in this industry, in the non-QM spending or the lending industry, are seeing a pickup in their monthly numbers, and they expect it to continue for the remainder of the year.
How big is the potential customer base? According to the U.S. Bureau of Labor Statistics, people calling themselves self-employed increased to 9.2 million in 2021 and from 8.8 million in 2019. That same report, however, showed that self-employed numbers dropped by 200,000 in February to just over 9 million. In other news, the increase in home prices slowed as interest rates pushed above the 5%, bringing affordability to an all-time worst level. Black Knight says home prices are up 6% nationally and income is down. As of April 21st, that payment-to-income ratio has now climbed all the way to 32.5%, within just 1.6 percentage points of the prior record. Ahead of its first quarter earnings report tomorrow, Fannie Mae has announced its guarantee book of business increased an annualized rate of 9.7% in March. Year-to-date earnings are up 7.7%. The last time Fannie Mae saw growth like this was in August of 2021 when it posted similar monthly results. Overall, Fannie Mae saw its retained mortgage portfolio activity increase 7.3%. And finally, Matt Ishbia, the CEO of United Wholesale Mortgage, has reignited its feud with crosstown rival Rocket Mortgage. Ishbia slammed the country's #1 mortgage lender for taking workforce reduction actions that he called disgusting. Rocket announced last week that it was offering a voluntary buyout to 8% of its employees. Rocket Vice President Jared Fleischer responded on LinkedIn by saying it was empty cynicism. He said there isn't another company in Detroit or this country that can match Rocket's record of philanthropy and community investment. The back and forth was posted on LinkedIn, where there were more than 500 comments.
This program was brought to you by Fannie Mae TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness.
For more on these and all of today's top stories, go to mortgagenewsnetwork.com.